At Maverick Ag, our goal is to assist and educate primary producers on all forms of business risk management. My name is Evan Schout, and I'm a CPA and CABE certified insurance broker. I've made my career focused on all aspects of primary producer business, including accounting, finance, and farm income programs. Our primary goal when starting Maverick was to provide farms a place to go to discuss, analyze, and identify options surrounding the risks on each of their own individual operations. We have created the Risk Management series of videos to provide farms an introduction into risk management. 6 short presentations that focus on the programs and internal processes that farms can take to reduce the stress that comes with farming. We hope you enjoy the content, and if you have any further questions, please feel free to reach out to us. Thanks for watching. This is episode 6 of the Risk Management series. After the drought, steps to take sooner than later for your operation. Step 1. Identify the damage. It is good practice in agriculture to have calculated the worst case scenario for the farm prior to seeding. This allows for strong decision making in season when drought or other perils occur. Assuming that you have not calculated the worst case gross revenue, grain sales and insurance proceeds, you need to make an estimate using conservative estimated yield and price. Using your projected cost of production, or historical if you do not prepare budgets, you need to identify the largest loss the farm will sustain. Once you know the worst case of revenue and expenses, you need to identify how this affects your working capital and your debt service, aka cash flow and the ability to repay your debt obligations. Step 2. Create a plan. Whether you utilize external advisors or prepare it internally yourself, you need to come up with a plan to mitigate the risk of the worst case scenario you just identified. This will need to encompass adjustments to the capital plan, putting off purchases or expansion, adjustments to the financing plan, debt payment assistance or restructuring debt, and lastly, what working capital or cash flow will be required to continue operating into the next growing season. A strong plan will encompass future planning of how to fix the current scenario and get the farm back on track for next year. It is important that you take all variables into account when formulating this plan. Step 3. Approach your financial institution. Do not wait until you get your accountant statements to provide updates to your bank. This will put you in a position of weakness, as they then hold the control, whether through covenant breaches or future financing holdbacks. If you include your relationship managers from the bank in your planning during Step 2, you will come out considerably ahead. In many instances, they will be able to identify areas in your lending to adjust and make sure you are not in a bad position. They understand debt restructures and debt payment deferral better than you do. In a worst case scenario, this also provides you time before your reporting covenants with your lender to shop other options. Most debt restructures performed are done out of planning, aka strength, and not out of necessity or weakness. Your bank and lenders will work with you. Step 4. No reactive decisions. In instances of risk, many producers make bad decisions in terms of debt. Examples are, rather than reducing the capital plan, they will obtain outside financing at much higher interest rates, leasing, retailer financing, etc. Producers will not plan repayments, and instead of paying off high retailer interest financing, they will not pay equipment bank loans, keeping high interest terms on the books. Farms will often choose tight working capital over using land to fix a cash flow problem. This compounds the problem, as now future decision making is done by cash flow and not margin. Step 5. Make a plan for the increased risk. Assuming you can work with your financial institution to move forward into the next growing season, you must now identify the increased risk. New risks may include working capital. You now have less cash flow to operate, increasing risk of having an effect on your decision making for margins, whether when to sell or when to buy inputs. Debt service. You now have 1 year of low debt serviceability. Banks use a 3-year average, so you cannot sustain a second year of low covenants. Costs. If you are tight enough that you must reduce some cost areas in order to sustain another growing crop. Your risk and insurance plan must take these factors into account. Most farms do not have the ability to sustain back-to-back years of loss and still have a plan B in their back pocket. Thank you.